We're starting to see a lot more red across the S&P in just the last week, and more specifically, we're noting the continuation of the downward trend in the healthcare sector, something that also applies when we look at pharma companies. And in fact, probably no surprises then that investor sentiment is starting to slow down. Whilst we have seen greed for quite some time, we have now entered into the neutral space. But maybe no surprises because the S&P has been on a very, very large tear year to date. Many companies, we're seeing incredible performances. In fact, quite a few that we can see showing some real strength in the double-digit increases. But unfortunately, healthcare and pharma, again, still looking very poor. We have companies like Merck & Co. down 22%, BMY very similar, and even with UNH recovering some of the large drop, that company is also battered. Now, if we go back to the wider market on a valuation on a PE basis, there is quite a lot of red right across the board, but actually we're starting to see quite the opportunities creeping up in the healthcare space. Again, this also applies to pharma companies where valuations are looking very good, and we'll also compare them to their 5-year average. And the story also seems to have a similar tune when we incorporate growth PG across the S&P. Whilst there is red across the market, we do get to see some patches within these sectors that we do ultimately want to cover today. Now, why are we specifically looking at both healthcare as well as pharma today? Well, let's just take a quick look at few companies across different industries. For example, if we look at Oracle, they're trading at a forward valuation of 41, which is well above their historical 19. And yes, we don't look at these in isolation. That is something we would potentially say is a severe overvaluation signal. And that's also confirmed when we take a look at the blue tunnel, which as always highlights the intrinsic value within the parameters. Not just now are we seeing massive disparity between Oracle's trading value and the upper end of the blue tunnel, but something actually noted over the last 12 months. And it's not just in that industry. If we take a look at Costco, even with the drop they faced today after the release of their earnings yesterday, forward PE 46, well above the 5-year average of 39. In fact, in pure isolation, you could already say that for Costco, this is a very high figure. Something that is also confirmed when we look at the blue tunnel. Again, yes, it is starting to creep towards the upper end, but nonetheless, we still notice disparity and overvaluation present, not just with Costco, not just with Oracle. If we looked at companies in the sector, the same would apply. For example, Costco, yes, is one in the industry, but Walmart would show the same conclusion. We can also move to the semiconductor space. For example, Broadcom valuation of 40, well above their historical 18 average, and the blue tunnel again showing the same conclusion. Disparity is in fact incredibly severe, well above even the upper end. And we'll just end highlighting this by also pointing out in the banking industry, for example, JP Morgan, 16 forward P above the average of 12.7. And needless to say, the blue tunnel again with the same conclusion. There is disparity, overvaluation does look to be present. So that's why today's focus is on a potential severely undervalued sector that includes healthcare, insurance, as well as big pharma. And we also notice some analysts believe there are companies within these industries that are showing a lot of promise. They are trading very cheaply and massive value for bargain hunters. But it also wasn't that long ago, a few months ago in fact, although some of these companies have bounced off the 52-week lows, where analysts believed that in particular the health insurance industry was chronically uninvestable. That includes the likes of ELV, Centene, which took a massive hit. And interestingly, the great investor Warren Buffett did take a position in United Health. And now with the continuation of the downward trend, analysts also believing Novo Nordisk alongside Eli Lilly, which we covered yesterday as a company to consider, do look to be in what they call absurdly underrated stocks to buy today. Worth highlighting that President Trump tweeted that starting October the 1st, they'll be imposing a 100% tariff on any branded pharmaceutical products unless they are building their manufacturing plant in America. Something to consider, although won't have a major effect on the likes of Eli Lilly. Novo Nordisk, we can take a deeper look in a specific episode. But as always, there will be some analysts that believe there is more pain to be had for investors in the sector. Wall Street still see health insurance as something that will continue the downward trend, and if you remember when we covered the earnings of some of these larger companies, their numbers were not impressive at all. In fact, we saw quite a lot of them cut their outlook. That includes ELV, United Health as well, although they in fact fully suspended it, and in the pharma space, Novo Nordisk, also another one that cut their forecast, although they actually did this several times. And if you want to see a deeper look at the company and some of the issues they face, then do check out one of our previous episodes. Now we're going to look at 7 stocks in these industries to consider whether they are a screaming buy right now. For example, Novo Nordisk, the opposite trend from what we highlighted at the beginning of the episode. Forward P 14.3, not only well below the 5-year average of 30.4, but that is, at least from the information we have today, a 5-year low, whilst in fact offering investors a yield of over 3% when historically it's been at 1.4. And to round this off, we get a triple undervaluation signal. Huge disparity between the current trading price today and the bottom end. Remember, previous companies, it was the flip side where it was sitting above, and it's only been increasing from the beginning of the year, so potential severe undervaluation. Each one of these 7, we are going to get a closer look into our own valuation model. The next one, Merck & Co., another 5-year low on the forward P. It could be more than 5 years, but we're just looking at this data. 8.4 versus 13.1, yield above 4%, historically near around the 3% level. And another one where we get to see disparity only increasing from November 2024. The price, in fact, or the intrinsic value at the lower end does sit above. Again, this is where opportunities do lie if you do believe in the longevity of these companies. Again, Pfizer, 8.2, one of the lowest in the last 5 years. In fact, we notice forward P of 11, yield sitting at 7.3%. That is incredibly high. It's only been around 8% at the peak in the last 5 years, historically around 4.3. And again, we are talking about companies that are showing undervaluation signals, trading below even the bottom end. Actually, something we haven't pointed out is that it is great to see the blue tunnel at least not decreasing. It is either staying flat or in an upwards trend, which is something you want to see at the bare minimum. We then look at ELV. As we highlighted, they did cut their outlook. Valuation at 10.3. It has been a little bit lower. We can see around the 8.5 mark, but against their 5-year average, still significant distance, 13.9. Yield 2.2%, well above the 5-year at 1.2. And you might be getting sick and tired of hearing it, but these are companies where disparity is incredibly huge and the intrinsic price doesn't look to be dropping severely or in fact at all. And actually quite interesting to point out, at least for LV, this one has been looking undervalued for quite some time. We then move on to Bristol Myers Squibb, under 7 in terms of forward P with the average at 8.2, yield 5.7, well above the historical 3.4. Surprise, surprise, the blue tunnel is highlighting severe undervaluation, something we always like to see as investors, but remember, this is just the initial phase before we take a closer look. Amgen, another one, although 13.1, it has been lower around the 12 mark in the last 5 years, but still below the 5-year average of 14. Yield 3.5, slightly above historical 3.2. And actually, when we look at the blue tunnel for this one, it is right there towards the lower end, so you could argue potential undervaluation. If we actually look at the last 5 years though for Amgen, this one more often than not does trade in a reasonable signal, so does look attractive when it gets to the bottom end of the blue tunnel. And finally, we have Sanofi, 9.3, one of the lowest in the last 5 years versus 11.5, yield touching around the 5% mark with the average at 3.8, and the blue tunnel showing again undervaluation. So let's kick off, look at these companies, also see what institutions are doing before we jump into our valuation. First one that we highlighted, severely undervalued, Novo Nordisk, down in fact around 2% today, down 56% in the last year. Year to date down 35%. Over the last 10 years, we can notice massive drop from just a year ago at around the $140, $150 mark, up 104%, so it has just underperformed the S&P, trading very near to 52-week low, and we get a double buy from both C Alpha as Wall Street. Now, institutions hold around 12% ownership. They sold $5.7 billion in just the last 12 months. They bought a little bit more at $7 billion, but we've noticed they've bought nearly twice as much in quarter 2. If we look at Q1, we actually see the opposite effect. So an interesting point to take there from the institutions. And regular viewers will know that for Novo Nordisk, we have two intrinsic prices. The first one, $46. We'll get to why this one is different. The second one at $72. Now we're going to cover the first one at 46, of which both are derived from the DCF model. What makes this different is that we have used the lower free cash flow growth estimation for 2025. This one is more appropriate for investors that believe the issues the company is facing is for at least the medium to longer term. Now, average growth of the free cash flow sits at 10%. We have gone more in line with analyst estimations at the 12%. But bear in mind, we have a low, medium and high, 10, 12, 14 respectively. As always, you can grab a copy of this model, running through your own numbers, whether it's for NVO or any others, but also worth flagging based on a reverse DCF model currently baked into the future free cash flow year on year is 14.8%. Now what we do is use the growth rate and the discount rate to give us the present value of future free cash flow and terminal price, add together with the cash, subtract total debt, get the equity value, divide by the shares outstanding to give us the intrinsic $46 price, which actually flags here downside of 16%. Now, if you want to be more conservative, at 10%, we can notice intrinsically 40, downside of 27, and if you believe we are being way too conservative, well, at 14%, $52, downside of 5. As we typically do, the middle rate we take through to the next slide where we want to calculate what is the margin of safety. There is none based on this model, as the current price does in fact sit higher. Now what we would typically start off with, 10%, we'd execute buy on that if it meets the 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that today, we'll buy at $41, but this is flagging if you believe the issues Novo Nordisk is facing is for the longer term, you're paying a 20% premium. Wall Street themselves see this at $68 into next year, translating to 24% upside. Let us know on Novo Nordisk based on this scenario. With the other one, as we said, coming to $72, this one is using their initial guidance, maybe more appropriate for those investors that believe the issues are in fact going to be short-lived. Also highlights a lower, as you would expect, figure for the reverse DCF, coming to 7.8%, and no matter which growth rate you use today, upside is for each one. Now using the middle rate, again 12%, we actually see the opposite, not a premium, a 24% margin of safety. Wall Street, again as we said, $68, 24% upside. If you wanted this at a 30% MOS, well, a buy at just over $50. The other thing we can do very briefly is highlight for those that want to use the average growth rate at 10%, you are still getting a margin of safety, naturally lower, and it sits at 13%. If you wanted 20, a buy at 51, and at 25%, a buy at $48. Stock number one, let us know, is it time to buy Novo Nordisk? Before we continue, we want to let you know that we have released our latest free weekly article. We drop one every single Sunday morning to your inbox completely for free, covering severely undervalued stocks as well as what's going on in the market over the last few days. So click below, you can sign up and read straight away, where you'll be able to gain access to severely undervalued stocks for the month of September. We will be dropping October's copy over the next few days. Lots of information included, as well as the upside that Wall Street themselves see over the next year. And on top of that, you can grab a spreadsheet of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock, which we did briefly touch upon earlier, Merck & Co, down 32% in the last year. Year to date, down 22%. Over the last 10, another underperformer of the S&P, trading right there near its 52-week low, quite somewhere away from 52-week high. We get a triple buy, fairly rare across the board from Seeking Alpha, Wall Street and Quant. And whilst we won't go into the depth today, you can see B+ on valuation, A on growth, and an A+ on profitability. Institutions themselves hold 76% ownership, selling $18 billion in the last year, buying twice as much. They bought a lot more in Q2, 11 billion buys versus 3 billion selling, and we noticed in Q1 also very bullish, twice the amount of buys. Now our intrinsic value, $108, the average of the 3 models that you see on screen, but what we'll firstly flag is if you solely wanted to use a DCF, $104, that baked in is negative 2.5% decrease to the future free cash flows. For our model, we've been conservative, or that we believe, at 0% over the longer term, and ultimately gives rise to a 29% margin of safety. If you wanted 35, a buy at $71, and at 40% around 65. Wall Street themselves, with a triple buy rating that we saw across the board, $102 into next year, 32% upside, but let us know your views on Merck & Co. The next one is Pfizer, down 18% in the last year, down 10% year to date. Over the last 10 years, down 29%. If you'd invested, let's say $10,000 10 years ago today, you would now be sitting on around $7,100. Not great at all, and it did pretty much peak around the back end of 2021 at $60. As of today, trading towards the lower end of the 52-week range, but a double buy from both Seeking Alpha as well as Wall Street. Now, institutions hold 68% ownership, selling $13 billion in the last year, buying a little bit more. They bought twice as much in Q2. In Q1, we actually saw the reversal, so at least we can say in the most recent quarter, they are in fact net buyers. Now, our intrinsic price comes to $31, where the DCF does come higher at $35. Highlights right now, though, baked in is no growth whatsoever to their future free cash flows. We have gone for 4% moving forwards, and in turn, using all four models, we get a margin of safety of 24%, a very, very attractive starting yield. And if you wanted 30% MOS, well, a buy around $21.70, and at 40, sitting around the $19 mark. Wall Street themselves, with a very attractive starting yield, see this at 23% higher into next year at $29. Let us know if you agree or disagree that Pfizer is a buy, maybe a hold, or in fact a complete avoid. We then move on to ELV, down nearly 40% in the last year, down 14% year to date, but over the last 10 years, not too dissimilar from the S&P, trading very near to its 52-week low, such a huge way away from 52-week high at $529, with a fairly respectable double buy from Seeking Alpha and Wall Street, 4.25, 4.23 out of 5. Now, institutions hold 89% ownership, selling $11 billion, buying nearly twice as much. They bought more than twice as much in Q2. In Q1, also, they bought a lot more. So in 2025, at least, whilst the share price has been suppressed, they've been buying quite a lot of shares. Now, intrinsically, we get to $462. DCF actually coming in lower, $374, not too dissimilar from Wall Street and their target. We've on 6% moving forwards, baked in currently sits at 4.1, but using all four models, which as always, you can grab a copy of this model by click on the pinned comment below, gets to 462 with a 32% margin of safety. If you wanted this at 40%, it would come to 277. Wall Street themselves see this 380 into next year, 20% upside. ELV, let us know if this is one you are considering. We then move on to Bristol Myers Squibb, down 13% in the last year. Year to date, losing nearly 1/4 of its market cap. Over the last 10 years, joining Pfizer in the club where you would have lost money if you'd invested in this 10 years ago. Pretty much trading at its 52-week low with just one respectable buy rating from Seeking Alpha, Wall Street and Quant with the hold. Now, institutions hold 76% ownership, selling $9 billion in the last year, buying twice as much more, buying twice as much again in Q2, and buying a lot more in Q1. So one we would say clearly in 2025, institutions do love quite significantly, and our intrinsic price at $62 gives rise to a whopping 31% margin of safety. Another company similar to Pfizer with an attractive starting yield. If you wanted 40%, well, it would be a buy at $37. Wall Street themselves see this at $55 into next year. That is 28% upside. Let us know though if you agree or in fact disagree on Bristol Myers Squibb, but could be one for serious consideration. We then move on to Amgen, down 15% in the last year, up around 3.5% year to date. Over the last 10 years, slight underperformance of the S&P, trading near its 52-week low. Double buy from Seeking Alpha and Wall Street, although on the weaker side, where institutional ownership sits at 77%, $12.5 billion selling, double the amount of buying, lots more buying in Q2, over 3 times as much. In Q1, more buying again. So like the majority of companies today, another one institutions are bullish on in 2025. Now, our intrinsic value at $341 using the DCF model comes pretty much in line at $339. tells us we're using a 5% growth rate baked into the numbers as of today, 2.7, 21% margin of safety. If you want 25, well, a buy at 256. If you wanted 30%, well, it would be a buy around 238. Wall Street themselves see this at $325 into next year, 20% upside, but let us know whether this is one you're considering. Amgen, in your view, a buy, hold, or avoid. And then we get to Sanofi, down 20% in the last year, down 5% year to date. Over the last 10 years, down around 5%. Trading pretty much around this 52-week low. A strong buy from Seeking Alpha, respectable buy from Wall Street, and a buy from Quant, where we notice institutional ownership at 14%. Not too dissimilar the buys and sells from institutions in the last year, and the same to be said in quarter 2, and that in fact in quarter 1. So a little bit more difficult to see if they are in fact more bullish than bearish. And our intrinsic value gets to $66, not too dissimilar from the DCF at 65. We've used growth rate of 4% in line with the average. Baked in today is pretty much no growth, in fact negative 0.5. Margin of safety whooping 31%. If you wanted 40, which is quite large, a buy just below the $40 mark. Wall Street themselves, they do like this one, $61 into next year, 34% upside, but let us know your thoughts on Sanofi as well as the other stocks today. Do you believe these industries are a screaming buy, or maybe one to completely avoid as you do see them going in fact lower? And don't forget as always to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.